continue with our discussion on what are the various methods of arriving at an optimal capital structure for a firm. And then we will look at what is the basic difference between the first approach that we have seen and the second approach that we're going to look at now. So we've already seen the cost of capital approach, which is that, we come up with the debt to equity ratio that minimizes the cost of capital. Now we are going to look at the operating income approach, which is also known as the enhanced cost of capital approach. Enhanced cost of capital approach. Earlier, we had just assumed that whatever number minimizes my cost of capital, I would want to go with it. But in real life, things might change in addition to just the cost of capital changing, right? We've already seen there are direct and indirect costs of bankruptcy. And so as you keep increasing the debt, in the firm, there will be an impact to the operating income as well. Operating income will start going down, correct? So effectively, as the company borrows money, there are chances that the indirect costs of bankruptcy cause the operating income to fall. If the operating income will fall, then it's possible that because of this, the free cash flow to firm will fall. It will fall. And hence, rather than looking at a single number for the operating income and just looking and saying that cost of capital has to be minimized, what we are saying is that we will now evaluate if the firm value itself changes because of change in the operating income, right? So there are two things happening here. One is your cost of capital is sort of changing, and we've seen that the change will be something like this for cost of capital. The second thing that we are going to look at is that the operating income will also change. This will basically keep going down with an increase in the debt to equity numbers, right? So as you keep taking debt, the bankruptcy costs keep increasing. So the costs of default or bankruptcy, as we have seen, will keep going up, and consequently the operating income will keep going down. Now these costs could include direct costs, these costs could include indirect costs. We've already seen that direct costs are the costs associated with the legal stuff around bankruptcy of a firm. Indirect costs are basically costs which will come due to loss of business and the loss of flexibility of doing business when you are running a lot of debt, correct? So that is how we will basically look at understanding how do we evaluate all these portions, how does the operating income work, and how do we work out with this sort of an approach overall in the income approach, right? We'll need a few things though. So under the operating income approach, the first things we'll have to figure out what is the level of drop in EBITDA or EBIT with the changes in the rating for the firm, right? So we are saying as the firm keeps increasing the debt, as you keep increasing debt, your rating falls. As the rating falls, EBIT of the firm also falls by this amount. So when we say that the rating has gone to D, we are saying EBIT will fall by 20%. And these numbers could be different. It might make sense to probably do empirical evidence of companies in the past where EBIT has fallen as bankruptcy costs have approached. And in the context of India, you could use examples of companies like Suzlon or Kingfisher who went into debt restructuring after taking a lot of debt. You could try and find out how much has EBIT fallen by year on year. It's a difficult exercise because you don't really know how much of the EBIT has fallen because of the bankruptcy and how much of the EBIT has fallen because of the business conditions. But assuming we find that this is the fall in EBIT, we can now calculate what is going to be the firm value. Remember, we will go back to our discussion of the firm value and we will assume that the firm is in steady state, right? For real analysis, we can actually remove this assumption as well. But in steady state, the firm's value will be free cash flow to firm into 1 plus the growth rate divided by R minus G. That's the total value of the firm, right? And free cash flow to firm, we will have to arrive at an assumption to that. We will also have to arrive at an assumption